Hi there, I'm David from DB Chartered Accountants. One of the first major decisions you will have to make as you start your new business is the form of legal entity it will take. To a large degree, this decision may be dictated by the way you've organised your operations and whether you intend to work on your own or in conjunction with others. The form of entity you choose can have a significant impact on the way you are protected under the law and the way you are affected by taxation rules and regulations. There are 4 basic forms of business organisation. Each has its own benefits and drawbacks and is treated differently for legal and tax purposes. These are sole proprietorship, often referred to as a sole trader, a partnership, a limited liability partnership, and a limited company. In this video, we'll consider sole proprietorship. If you're a person acting on your own and you simply start up in business, then you will, as a consequence, be operating as a sole trader. A sole proprietorship is thus typically a business owned and operated by one individual. Sole proprietorship is not considered to be a separate legal entity under the law, but rather an extension of the individual who owns it. The owner has possession of all the business assets and is directly responsible for the debts and other liabilities incurred by the business. The profit or loss made by a sole proprietor is combined with the other income of the individual for income tax purposes. A sole proprietorship is perhaps the easiest form of business to own and operate because it doesn't require any specific legal organisation, except of course the normal requirements such as licenses or permits. A sole proprietorship typically does not have any rules or operating regulations under which it must function, and the business decisions are solely the result of the owner's abilities. So what are the advantages and disadvantages of sole proprietorships that you need to consider? One advantage is the fact that there are usually no formation costs. As such, they are a cheaper option for starting up a business. Other than reporting their income to HMRC, there are no legal requirements to file accounts for inspection. Thus, financial standing can be kept confidential. Profit extraction is simple for a sole proprietor. Any money in the business bank account is legally owned by the business owner, and thus they can take the money for personal use without any tax consequences whatsoever. Unincorporated businesses do have an advantage if losses are anticipated in the first year. The startup losses in the first 4 years can be set against other income of the same tax year or be transferred back to the 3 previous years, which could result in a tax refund. So in summary, a sole proprietorship provides an easy, inexpensive way to set up in business, with tax advantages if losses are incurred in the earlier years. Personally, I worry about businesses that operate as sole traderships for the principal reason that they are personally liable to the full extent of their indebtedness. In this day and age, there's always someone who would take legal action against you given the chance. A person acting as a sole trader would personally be more vulnerable to such actions. Would you really want to put your house and all your personal assets at risk to such threats? Sole traders, unlike owners of limited companies, have little control over the amount of income that they are taxed upon. All the profits that they earn are taxable at their highest marginal tax rate. The tax is usually payable by instalments on the 31st of January within the tax year and the 31st of July following the tax year. If you are a startup business, then you will need to save for your tax liabilities to ensure that you have money available to pay the tax when it's due. Typically, you might have a low tax liability on the 1st of January that follows the first 5th of April that arises after your start date. However, due to the impact of payments on account that sole traders may face, the next tax bill can be disproportionately large if your profits are rising. Sole traders are subject to tax as soon as their profits exceed their personal allowances. In addition to tax, they also have to pay Class 2 and Class 4 national insurance contributions. Thus, the amount of tax and national insurance payable can be more than would be payable through a limited company, particularly if profits are high. Operating a sole trader, rightly or wrongly, projects an image of being a small business and does not carry the prestige that a limited company can offer. Whilst businesses usually start up as sole traders in many instances, they eventually come across some reason or other to convert to a limited company at some point in time. We'll consider operating as a limited company in a later video. Thank you for watching this video. Please subscribe to our YouTube channel so you receive notifications when we upload new videos. Please also share this with others on your social media. Please keep safe and well. Bye for now.